one of the things that we we pride ourselves on is the aspect of planning. And so whenever someone comes to us, it's not just, here's my money, manage my money and just make me money. It's more so, it's like, okay, like, what is the goal of this? Like, what is the time frame? And so a lot of the people we work with are working towards what we call vocational freedom. People used to refer to as retirement, but our experience has been that people really don't retire anymore. They just reach this point to where work becomes optional.
Hey, you're listening to the Friends in Austin podcast. I'm your host, Justin Talent, and every week I bring you the stories of the people of Austin. Thank you for listening. Hey, welcome back to Friends in Austin. Today, my guest is Clayton Boone, who is a personal finance expert. Is that an accurate description?
Expert's a little strong, but I definitely am familiar with some personal finance stuff, yeah.
Well, so what is your job title and how long you've been working in personal finance?
Job title is lead financial advisor at Brighton Jones. I've been involved in personal finance for nearly 15 years. Variety of different roles, from institutional sales to asset management to financial planning and tax strategies and estate planning, things like that. So
what's your specialty right now? Because I know that obviously, I guess there's a lot of different categories of personal finance. What is your typical clientele right now?
I work with a lot of entrepreneurs, as well as what you could say kind of the corporate ladder climbers, a lot of people that are maybe starting out in their job, have had some early success. Maybe they're dealing with some equity compensation issues like stock options or RSU units, as well as just trying to figure out, like, hey, I've got this income. How do I utilize it to support what my goals are, but at the same time, maybe align my values with the money that I do have too?
Makes sense. So you work with entrepreneurs, huh? What kind of personal finance advice are entrepreneurs looking for when they're coming in there? Is this based on their company, or is it actual personal finance?
Yeah, it takes a variety of avenues, really. When working with people and they come in and say an entrepreneur, a lot of times the things that's on their mind is, all I've done, my biggest personal asset at this point is my business. And what we find is that they get to a certain stage to where now the business is working, they're starting to see positive cash flows, yet a lot of their net worth and their future is tied up in this business. And so they start to think about, how do I access that capital in a very tax efficient way? And then how do I start taking some of these additional cash flows and start to, separate those savings assets from my business, so that I don't just have all of my income, all of my net worth tied to one asset.
We can dive more into that, but I'm curious about Brighton Jones. Is that a big company, a small company?
I guess from a financial services standpoint, we're not like the big, huge wealth management firms that have like literally trillions of dollars in our assets under management, but we are a very large registered investment advisor. It's called an RIA. And so we're actually a fiduciary. So we're liable for the advice that we give.
What is a fiduciary?
So it's somebody who's legally liable for the advice they give. So for example, like a lawyer serves as a fiduciary to their clients. We, as an RIA, we also serve as a fiduciary to our clients. So once again, it's the advice that we give, we can be held legally liable for. And it's just it's a higher level of client alignment. Like, we sit on the same side of the table as you, as opposed to trying to sell you products.
Yeah. So my girlfriend's really into personal finance. I tried to convince her to come in and sit on this episode because she would ask better questions than me, but she's too shy. She's like, no, I'm too scared. I'm not going to do it. But she's talked about like some personal finance is kind of like they are obligated to help you. And then there's other people that are kind of scummy and like they're not necessarily aligned with an outcome for you.
Yeah. I mean, it's possible. There's definitely some bad actors in our industry. And then there's some really great people that aren't necessarily in an RIA. Maybe they're in like a broker dealer, which is kind of your typical thought process for financial advisors. But there really are some fantastic people in there too, but they just don't have the same legal liability that a registered investment advisor, an RIA, quite has, as far as that they owe to their clients. And so I think, which is one of the reasons why I joined an RIA, as opposed to maybe going back into what I call the broker dealer world, which is what a lot of the big names that people are familiar with out there. Okay,
so I want to dive into like where different people are at different stages and what they can do with their personal finance. But before we get into that, I was curious how long you've been in Austin.
Yeah, so I've been in Austin for almost 7 years and grew up almost in Texas my entire life. I won't admit it too much, but born in Oklahoma, moved to Texas in actually moved to Illinois, and then moved to Texas in the 3rd grade. And so I've been here ever since. We lived in Dallas, and then from Dallas, we moved to Austin.
Cool. What brought you from Dallas to Austin? Work?
Yeah. So prior to joining Brighton Jones, which is the firm I was at now, I was at Fidelity Investments. Pretty well-known, big old firm, great firm, a lot of love for them. Helped me out so much. They introduced me to just really kind of like my own investment philosophy, which is necessarily not the philosophy of, hey, pick stocks and this is how you're going to outperform, but rather it's, be mindful of costs, turnover matters, so do taxes, stay diversified, and just try to get what the market gives you and structure a portfolio that way. And so I sort of learned that through Fidelity. And then likewise, I went to work for a company here in town called Dimensional Fund Advisors, DFA, which is another big mutual fund company. And DFA is what brought me to Austin.
Cool. So what got you into personal finance to begin with? Did you go to college and just major in finance?
Yeah. So I majored in finance, and you're going to laugh because so today is at my son's school, it's superhero day, and he gets to dress up as his favorite superhero. And right now his favorite superhero is Spider-Man. I mean, why wouldn't it be? But what's funny is when you ask him, it's like, what do you want to be? And it's like, yeah, I want to be Spider-Man. Whenever I was young, I wanted to be businessman. Like, I kid you not, I really wanted to be businessman. And I have no idea why, because my dad wasn't a businessman. My dad was the superintendent for a commercial painting company there in Dallas, but he had a briefcase and it was underneath his bed. And I used to just take that briefcase, I'd put papers in it, I would write like words on it, and I would like carry it around and be like, I'm businessman. And so I had like this like mental model of what I was going to be when I grow up. And it was like businessman. And then
what were businessman's powers?
I have probably nothing.
Just a briefcase full of paper.
Briefcase full of paper. Just, talk a lot, but convey very little meaning. I mean, right. And so, yeah, that's what my businessman powers were. And so as I got older and I got into college and I started to think about, how did I want to like impact, the world per se? I mean, that's kind of like a really big thing, which is like, what could I do that I felt passionate about, that I knew people had needed help with? And that's how I found myself taking a bunch of finance classes, fell in love with it, transitioned, into being what I wanted to be called a stockbroker at one point. So I found a firm and I was like, am I a stockbroker? And somebody was like, yep, you are. And I was like, yeah, I made it. And then you come to realize doing that wasn't necessarily giving advice. Instead, what I really was an asset gatherer. Because all I was doing was essentially talking with people and just trying to get them to give me their assets so that I could manage them and, a portfolio. And so I make this joke. It's like, you get a 60-40 allocation, which is 60% stock, 40% bonds. And it's like, you get an 80-20 and you get a 70-30, which are common investment models. But I wasn't giving advice. I was literally just trying to gather assets, and maybe I'd meet with people once or twice.
Felt more like sales.
Yeah, it was literally just sales. And, sometimes that model and that way of life works for people, people that are just accumulating, maybe just taking the advice of putting it into some sort of model of 60% stocks and 40% bonds or 80% stocks, so forth, like works for them. But I did. I felt like it was sales. I didn't feel like I was actually providing financial advice. And I actually left the advice business and went into more of the mutual fund sales business. And that's how I ended up at Fidelity. That's how I ended up at Dimensional. But then while at Dimensional, I actually got introduced to the RIA world, which is truly wealth management. I mean, they're talking with people about taxes. They're talking to people about estate planning. We talk to people about philanthropic giving. We talk with people about how to align their values with the wealth that they have and the purpose, and just like, what does all that mean even outside of the balance sheet? And once I saw that, I was like, this is something. Like, this is really what I want to do, because this is making a difference for a lot of people. And so I went back into the wealth management space, but specifically went to an RIA as opposed to, one of these asset gathering type shops.
Gotcha. So what kind of things are you teaching people through these RIAs that you find the most valuable? And I mean, I'm sure it can vary depending on where the person is in their life, but we can dig into that.
It's really just the first stop is, depending on where people are, is trying to figure out, what is your investment philosophy? And so I think that's probably one of the first things that people need to figure out is, how are you going to actually invest your dollars? Like, what do you believe in? And it's not to say that one investment philosophy is better than the other. And whenever I say, what is your investment philosophy? It's what I'm talking about is, how do you feel that you can generate returns? Is it, you feel that the market does a really good job of pricing securities, meaning that you can't beat the market by picking stocks. So let's just buy everything and buy an index fund. Or do you believe that, you know what, I have more information than the market does or somebody else. So I think that this stock is better than that stock, and I'm going to go in and out of this stock, or I'm going to go in and out of the market and do all these different things because I feel like I have more information than other people. And that's how you're going to manage your money. So those are generally the two common approaches as far as an investment philosophy. And so it's just figure out what your investment philosophy is, and once you have that, stick to it. Don't change it, unless there's like a really good reason.
What kind of, let's say someone comes in and I mean, maybe they've accrued some wealth. I mean, I'm assuming people that have accrued some wealth probably do have some kind of investment philosophy by the time they get to that point. But don't you ever run into people that are like, I don't really know what I threw some money in some stocks. I mean, that's it. You know, what do you tell those people? How do you find an investment philosophy for them?
Those are generally some of the most enlightening discussions, because people that, you know, they've generated some wealth, maybe they've bought some stocks along the way. Like most recently, I mean, you hear Tesla all of a sudden is like a third of the US market cap. Like it's just something crazy. It's probably
undervalued or overvalued.
I have no idea. And that's my investment philosophy, is that like, I don't know, like the market's going to tell me what that price is. Mm-hmm. And my philosophy is pretty much that small caps have done better than large caps. Value stocks have done better than growth stocks, and more profitable companies have done better than less profitable companies. And so if you look at Tesla, at one point, Tesla was a small cap stock. And so on expectation, they should do really well relative to large caps. Now that Tesla is a large cap stock, my expectation is that they will do not as well as a small cap stock. So,
and a large cap references a large market cap.
Yeah, like a really big, like Walmart.
Like the electric car industry is the cap for Tesla, right? Or energy too.
Yeah, so I would say that the electric car industry is more or less the sector for Tesla, and then the market cap would be the value of all of those companies combined. And so it's just, you can think of traditionally within investing, you got small cap stocks and large cap. And so your small caps are generally like your startups, people that first IPO. They're small, like Facebook at one point was a small cap stock, and now all of a sudden it's a large cap because the company's grown in size. Apple started out as a small cap stock. It grew in size to a large cap. And so you've got these big mega companies, and then you've got these smaller companies.
Gotcha.
And so historically, we've seen small cap companies have higher returns than large cap. And a lot of people link that to risk. And so it's kind of like, if I were to go to the bank and ask them to lend me $1 million, and then Elon Musk went to the bank and asked them to lend him $1 million, do you think the bank is going to lend me the same $1 million at the same interest rate that they're going to lend it to Elon?
No.
They're probably going to give Elon a much lower rate, because Elon is perceived to be less risky, and risk and reward are tied together in the stock market.
Gotcha. So when people come in though, and they want to know their investment strategy, what do you tell them? We
pretty much lay out for them as like, hey, our investment philosophy is that we believe in broad diversification, we believe in low cost, and we believe that, you know, you can't really pick stocks to beat the market. You can, however,
if it's coronavirus, you can. I'm kidding, but I'm saying that like that's a lot of that's going on.
No, that's totally fair. That's totally fair.
And it's almost like you click a button and it's like, oh, it's up. Like,
yeah, I know, right? That is 100% fair. And it's been a phenomenal time for people to be invested right now. And I've certainly hoped that people have been able to experience that, especially consider like if you were invested pre-coronavirus and then you saw that massive dip, like it was a really challenging time working with our clients, because I mean, there was a lot of fear. I mean, it wasn't known that it was going to come back like it did. And so we were really fortunate to be able to work with our clients in a way that, you know, we were able to keep them invested within the framework of their financial plan. And then now here we are, it's hard to say, like a year later, they're doing fantastically well. And a lot of that had to do with the fact is that as the market started to dip down, you know, pretty much our portfolios are made up of stocks and bonds and real estate. And so as the market dipped down, their equity exposure went down, and then their fixed income exposure went up. And so as those fixed income values went up, we started selling the fixed income and reallocating back into equities. And so then whenever the market rebounded, our portfolios and our clients, we're well positioned to capture that rebound.
Gotcha. What's a fixed income asset?
It's like a bond.
Okay.
So typically like Walmart will issue bonds, say Target, a variety of companies issue bonds to finance operations or expansion or things like that. So bonds that pay like a fixed coupon of 3% or 4%.
So you sold those to invest them in what?
Back into the stock market.
Okay, back in the stock market.
Yep. We didn't sell them all.
Was that a tough sell?
It was, for some people, it was scary because it's like, wait a minute, like my fixed income assets, which serve as kind of my safe haven, the ballast for my portfolio, whenever times are bad in the market, typically your fixed income goes up. And so that's what kind of offsets some of those losses in equities. But so then all of a sudden you're talking to someone and they're seeing their equity portfolio go down and they're seeing their safe haven kind of safety assets, their ballast asset, they're going up. And here I am as their advisor saying, we should really start to think about rebalancing out of fixed income, taking those gains in fixed income that are over the targets that we set and put those back into equities because
there's a dip, right?
There's a dip. And so let's buy that. And it has nothing to do with market timing. It's just a matter of timing of equities go down, your fixed income goes up, rebalance back into equities.
Gotcha.
Nothing to do with timing. It's just portfolio management. And so a lot of people are like, you want me to do what? It's just going to keep going down. And it's like, it could. Like, we don't know. It very well could, or it could go back up. And from a portfolio management standpoint, we're at a point that we think that we should take some of these gains from not all the fixed income, just some of the gains, and put those back in equity so that if and whenever the market turns around, we don't know when that is. We believe it will, but we just don't know when. Whenever that happens, you'll have now more money in equities to be able to take advantage of those gains. And some people were able to do it. Some people said, let's just stay the course and kind of see how it happens. But yeah, I would say they were scary conversations, but a lot of people benefited from us just employing our portfolio management kind of philosophy.
What kind of stocks were you putting your clients' money into from that fixed income profits?
Yeah, thousands of stocks. Yeah. So our portfolios typically have 3,000 to 5,000 different securities in them. And that's because they are pretty much the US, international developed countries like Europe, as well as emerging markets like Asia, Russia, all of those. And so across that, you can imagine there's 3,000 to 5,000 different stocks, different companies that we buy into. And so we would rebalance out of those fixed income, also hundreds of thousands of fixed income securities. We would sell a portion of that to buy these equity securities. And we do that through mutual funds and ETFs.
So did you get a lot of scary people that were scared calling you?
Absolutely. I was scared. I'm a financial advisor. There's nothing more unsettling than to lose money. Anybody who says I love losing money, I'm like, okay. I just don't know how to answer. How to respond to that. So yeah, it's incredibly unsettling. One of the things that we pride ourselves on is the aspect of planning. And so whenever someone comes to us, it's not just, here's my money, manage my money and just make me money. It's more so it's like, okay, what is the goal of this? What is the time frame? And so a lot of the people we work with are working towards what we call vocational freedom. People used to refer to as retirement, but our experience has been that people really don't retire anymore. They just reach this point to where work becomes optional. And
they get to work on something that they want to work on.
They get to, I would argue that you've reached vocational freedom because I think this is a passion from a prior day job, right?
Mm-hmm. Yeah.
Yeah. So we're trying to get people to experience what your experience is, vocational freedom, to have the financial security to be able to work on the things that they want to work on. And sometimes that takes 5 years, sometimes that takes 15, sometimes that takes 20 years. But having that perspective in mind as far as a time frame of what we're shooting for. So whenever someone's portfolio, say, has a negative return and the market returns negative and the portfolio drops, we will then look at the portfolio and say, hey, based off of the time frame that we have in front of us, 10, 15, 25, 30 years, is there enough time for this portfolio to rebound and still get you to reach vocational freedom on the time frame, the trajectory, the target that you want? Usually the answer is yes, because we've built portfolios to perform in a variety of markets. And so we're able to more or less rely on that and say, hey, based off of the way that we've we've engineered the portfolio and we've built it to behave in a variety of markets. While this is very scary and this is a very real emotion that you're feeling, like there's still light at the end of the tunnel. Like we're still on track. And so that makes that conversation so much easier and so much more manageable for people, is that they can still see like, okay, like, yes, we're down and we knew this would eventually happen, but I'm still okay as long as I don't sell. And so that's how those conversations went. And those were really positive. I can't imagine what it would be like to just be like, you know, I'm an asset manager and I'm the guru who knows what's going to happen, and to be able to have that like, I don't know if I could do that. I
think that's a really great business to be in, or a great mission that you have, is helping people reach vocational freedom. Because I mean, that's something I think about a lot. And I think that, I talk about it with friends all the time. A lot of people have jobs they don't like. There's not a lot you can really do about that, except for work your way out of it and plan a new mission. But like usually your expertise is in like, you're kind of all in because you went to college for a particular thing. So you're kind of boxed into what you're educated in, unless you want to take a huge pay cut. It's like, well, I'm educated in this and my salary is at this level on this. I don't like this anymore. And a lot of people, they do like it for a while. But I think after like 7-8 years of doing the same thing, even something that's considered a good career that is high pay, it's like that's a long time to do something.
Yeah.
And you change and you just become disinterested. And then it's like, what do you do now? Cause like I can get paid this doing that, but if I switch, I'm just going to start back down here. So what do you do? But I think that, kind of a world where everyone has a clear path to vocational freedom, like from an early age somehow. And just to get to people to start working on what they want to work on. Cause I think that's when people make the best stuff, really. They have the most fun and they make the best stuff and they provide the most value. So yeah, it's a good thing to work towards.
Yeah.
What are some smaller level, like somebody, your clients, they have some amount of money, right? You know, you're not working with people on how do I get to a point where I can have a portfolio, period. So do you have any tips for people that, you know, just kind of want to get their finances in order and get in a place where they can start to manage their finances? Yeah,
absolutely. And actually we have the ability to work with people that maybe are just getting started and are looking to essentially put in what we call a foundational plan. And so we have something that it's called Open Plan, and it's essentially an online full-time financial advisor who can take people who are looking for that foundational plan of how do I get started, how do I build a portfolio, and help to build them one, and then be their advisor essentially through Zoom. And so that's something that we made an investment in a couple of years ago, and it's called Open Plan. So we are able to work with people in that manner. The other side of what we do is called personal CFO, and that's where we start to act in the capacity of a personal CFO for somebody in their wealth and for their family. So, but to get back to your previous question of like, hey, what can I do from a foundational standpoint? It's, you know, if you're working in a job and you happen to have access to a 401k, that is a fantastic place to start saving, is your 401k. Especially if, say, you've got a 401k that offers a match. A lot of them say offer a mandatory, like a 3% match or 4% or whatever. Just at a bare minimum, just make that match, because that's free money that they're giving you. Now, if you don't have access to a 401k, I'd still encourage you to save anywhere from, 5 to 10% of your savings. If you can just get in the habit of doing that early on, you'll be far and away surprised by how much you can actually amass to utilize one day for vocational freedom or for something else. But if you have access to a 401k, that's the first place to start. If you don't have access to a 401k, start saving in an IRA or a Roth IRA. Those are two fantastic tax advantage savings vehicles, and just max those out.
I wish I would have done that from an early age. I was terrible with money up until I was 28. And not that I'm still great with money now, but like horrid. Like, just like, and it's just, if I just would have started saving money, like when I was even 20 years old, like just a little bit, whatever your income is, even if it's, it wasn't high, I was young and you don't have any skills, but even if I just like automate 5%, I would have like gone so far.
I know. $50, $100 a month. If you're doing it at the age of 21, like it is, compound interest is a very powerful tool. And like you can amass a lot of wealth very quickly just by starting early. And even if it's only $50 or $100 a month, It's a fantastic starting place.
And then I think that helps you set the footing for, that vocational freedom. And then also it's like, then you actually have cash to where if you see an opportunity, maybe real estate, maybe something else, to start renting places out. Like maybe you want to quit your job for 6 months and explore a new skill, but you can't because you don't have enough savings to pad you.
Yeah.
So just basically having that as an option, it really opens up your opportunities and allows you to capitalize on different things and feel less stressed.
Yep.
It goes like so far.
Yeah, exactly. And to your point, a lot of times if somebody doesn't have, say, an emergency savings and they don't have a retirement savings, and so, or a vocational freedom type savings, it's like, where do I start? Do I just fund the vocational freedom and do I ignore the emergency? It's like, no, actually I would probably encourage somebody to split it up. If you've got a 401k available and the match is 5%, go up to the match and then start saving outside of that up to whatever you can a month and try to get to 3 months of expenses and in liquid type bank account type savings, because you could have an experience where it's like, you know what, I do want to take off for a month and a half and I want to go travel. I want to go do this. But if you don't have the money, you can't do it. And that's where that emergency savings can come up. Or we unfortunately have another event like we just had with the pandemic and we're still going through it. A lot of people lost their jobs. And unfortunately, some of them, weren't prepared. I mean, it's pretty hard to be prepared for a full year of unemployment. But like if you have 3 months of savings, it can help cushion that transition. And so I would encourage people to, if they have nothing and they're just starting out, split it. Half to vocational freedom, half to emergency savings. The vocational freedom, put it in the IRA, put it in the 401k. And then put the emergency savings in like a high interest type checking account at like Ally Bank or Markets by Goldman Sachs or, one of those online bank accounts.
Those high yield online savings.
One of those high yield online savings accounts. Those are fantastic places.
Also, can't you take like your 401k on your first house? Can't you take some out as a down deposit tax free?
Yeah, you can. Yeah. They call it a one-time home purchase kind of withdrawal. And you can withdraw up to $10,000 to make your first home purchase. And homes are a great place to really start out. I know a lot of people have the mindset of like, I don't want to rent because I feel like I'm throwing money away. The reality of it is your first 10 years of having a mortgage, you're going to barely pay any of the principal off. And so I would encourage people not to use their IRA or their 401k to make their first home purchase. Rather try to like save up for it and keep that money in that vocational freedom account for as long as you can. Because the longer it's in there, the much more it's going to benefit you than putting it in a home that arguably right now you can get money really cheap.
You can get money really cheap as in for a mortgage? Oh yeah, because the rates.
Yeah, the rates are historic lows right now.
So how do you feel about real estate as an investment avenue outside of portfolios? Like, obviously in a market like Austin, if you bought at the right time, it's going to go way up, but maybe you live somewhere else, you could buy a house that goes down. Also, like sometimes the roof breaks and stuff like that.
Oh, yeah.
So I've heard mixed advice from personal finance people that are like those personal finance influencers, like Ramit Sethi. Have you heard of him?
Yeah.
I think it's just part of his little shtick. He's like, I'm rich. I could buy a house right now, but I don't because I rent because, a home's distracting and like you could have all these expenses. But then I talked to some people that are like, if we hadn't bought our first house 5 years ago, like that's kind of really the, what gave us any money to begin with, because we were able to sell that house 5 years later. And it's like, we weren't that good at saving. And then the house value went up and that kind of put us on a good footing. And we've been on a good footing ever since.
Mm-hmm.
So you hear people like that, then you hear like, don't buy a house, rent.
Yeah.
I get his philosophy about, because when you buy a house, you tend to, you got to furnish it. Then it's like, oh, maybe I should pimp out the backyard. Like it just leads to the spending, just piles up. I get it. But I don't know. I think there's value in having a house and having a nice place to live. And also the fact that, yes, a lot of it, the interest is front loaded, but a lot of people make, some return on their house.
Oh, and there's also tax advantages to having a house. Like if you have a home loan, you can deduct some of the interest up to a certain amount off of your taxes. And then, home repairs. Home repairs matter. They come up and people always want to do stuff to their house. I have a house. You have a house. A lot of the people I know in my profession, just so forth, has a house. It is a great gateway into building wealth. It truly is. And we advocate for people for home ownership. People rent, and I know several very successful people that rent homes as opposed to buy a home. because the reality is that homes are expensive. It's not just the mortgage payment. It's not just the taxes. There are repairs. There are things that you want to do to it, but it's yours. Like, it's your asset. But at the same time, with renting versus having a home, is rent goes up every year, maybe every 2 years. And whereas your mortgage, that's a constant payment. And then once you pay it off, you're done. You don't have this anymore.
And you can refinance it to a lower payment. And
you can refinance to a lower payment.
Yeah.
Exactly. And so one of the things that, there's the, this kind of like, it's the FIRE movement, and it's financial independence, retire early. And part of that, and just in general, it goes forth in our own planning. It's once you go into retirement, you don't actually have to have a ton of money to retire. You just have to have low expenses. And so one way to have low expenses in retirement is to pay off your home or not have a rent payment. And so it's a store of wealth. And I'm not against people owning a home. I'm not against people having Airbnbs either. We actually have a gentleman in our firm named Scott Greavy, who is a real estate advisor. And all he does is he works with our clients to better understand just the portfolio of real estate that they may have. What does that do to support the financial plan? What type of return they're getting on it after tax? What's the cash on cash return? And then, should they refinance it to generate additional returns and maybe go into another property? Should they sell it and do something else with it because it's no longer serving their portfolio? So yeah, he talks to people about how to create a roadmap for real estate within their portfolio. So I think real estate's a great component of a portfolio. I would caution people to say, don't make it your only asset, but make it part of a broader portfolio.
Yeah. I've always thought real estate was fascinating in the way that it almost feels like cheating, in the way that, like, if you can get approved for a loan and you buy a place and then you rent it out, like someone else is just paying the loan. Like, you got, it's just free money. So, I'm not surprised. I'm surprised more people aren't into that. What are the downsides of what could go wrong?
Well, there's a lot that can go wrong. I don't know what all of it is, but there's a lot can go wrong. There's a lot that can go right also. Okay. I think that with real estate, one of the things that people struggle with, or maybe some challenges that present themselves, is it's hard to be cash flow positive in real estate, especially with a very minimal down payment. Once you consider taxes, the actual time that it takes to get a place in shape and find a new renter, and maybe the time that somebody's not in it, the fees that you may pay to like Airbnb or a management property, repairs, like there are some costs that add up very quickly that make real estate not cash flow positive. Now, a lot of people that I know that have made money in real estate is not coming from the cash flow as much as it is coming from the appreciation of the asset whenever they sell it and then trade up into other properties.
Yeah. So like, even if you're breaking even on the rent, you're still getting that asset, right?
You are.
Yeah.
Yep. You're still getting that return. And so then it comes into a perspective of at some point the leverage is no longer working as much in your favor. Like, you've paid more down on the property to get yourself to cash flow positive, and therefore you're not getting that kind of like leverage that you get from financing a property. And so then it just becomes a matter of running the numbers on it, figuring out what is the after-tax return of it, and are there other opportunities out there that are greater than that? And if there's not, then great, you keep that asset, that home, that real estate, and you continue with it. If there are, then you sell it or you refinance it and you find something else. But it all just comes down to opportunity cost. And some real estate does fantastic. We see it with our clients, and sometimes it's not as great.
Hey everyone, this is your host Justin. I just wanted to thank everyone for listening and give those that are new to the podcast a reminder to please subscribe to the podcast on your favorite podcast player. If you're on YouTube, please like the video, share it with a friend. That helps us out. Thank you. What kind of situations are you running into when it's not as great? It doesn't appreciate like they thought it would. The repairs come into maybe the foundation, there was a problem.
All of that. Yeah. That's generally what it is the cash flow is not quite what they expected, doesn't appreciate in the manner that they thought, and repairs become more than what they expected. And so those are generally like the three things. Like I said, there's untold countless other things that come into play, but primarily that's really what it is. And it can be a headache. I had a property in Dallas that flooded, and I was here in Austin, and having to deal with that, just the mental stress of not being there and having a property that flooded with a tenant that was having to experience it. Like I felt for the tenant. And so there's also that kind of part of it. But as I mentioned earlier, people have fantastic experiences with real estate, and we have clients who do really well with it.
Okay, so let's say I'm a younger person. I've started my career making a decent salary. You touched on some things. You said, obviously invest beyond your 401k. Definitely match your 401k. Then even open up your own IRA or whatever. What after that? Just keep doing that?
Yeah. So if you can max out your 401k, so if it's, hey, I've got this big income, what do I do? And I think first order of business is max out your 401k, which is $19,500. That's the amount that you can put into it. Next order of business is if your 401k has what they call an after-tax option, meaning that you can put your after-tax money back into your 401k. A lot of companies are starting to make this available. And so people can actually put an additional, what is it? I guess it's probably roughly about $37,500 back into the 401k. So people can get up to $58,000 into a 401k. And then if they immediately convert it to a Roth, that means that money that's in there now grows not only tax-free, but it's tax-free when they take it out. So it's like if you have a big income, max out your 401k, especially if you have an after-tax conversion, and then utilize that Roth conversion inside the 401k. Next up, you probably can't contribute to an IRA anymore if your income is to the point that you can contribute 58 into a 401k. If you have access to an HSA, a health savings account, you can put money into that. If you don't touch that for medical expenses, that actually grows also, tax deferred. And then at the age of 65, you can access that for retirement or vocational freedom without penalty. You'll just pay a tax on those gains. And so it's first order of business is really just make sure you got an emergency account, 3 to 6 months worth of savings, also or cash flow based. 401k, after taxing your 401k, do your HSA. And then, if you've got more money left over, save outside of that, whether it's buying real estate or just continue to invest in a brokerage account, buying mutual funds, things like that.
Okay. What if you're someone that is, maybe you're in your 50s, you've obviously had a retirement account your whole life. Maybe you've just done the standard of I've just matched my retirement for X years. What could you do for that person if they walk in and they want to come talk to you? You just kind of reorganize their investments or what?
Could be. That's whenever we start having a conversation of like, hey, you're 50. Let's sit down and understand, like, what are your goals? What are your values? Like, what do you want to do with this money? And if it's, I want to reach vocational freedom as quick as I can. It's like, okay, so how much do you make now and how much are you spending? And so once we understand how much they're spending and we understand the size of the portfolio and what their timeframes are, we can then back into what is a sustainable income stream that they can draw from their portfolio. And once we understand that, if it matches up with their expenses and they can live with that, it's like, you got vocational freedom. Like, you're done. If it's, we need you based off of your savings rates, like you'll hit vocational freedom in 5 years. And so that's whenever that conversation starts to take that vocational standpoint. But at the same time, they go from, say, an accumulation phase of saving at 50 years old and they hit vocational freedom. Then it's a distribution mode. And so then it's just talking to them about, okay, now you're going to start distributing assets. We need to manage a portfolio that can sustain your income stream, takes out kind of, the chance that these dips in the market materially impact you. And while at the same time, we need to pay attention to taxes, because as you're selling investments and you're doing like that, doing certain things to generate income from your portfolio, like those are taxes are starting to come into play. So what can we do to minimize taxes? And then the other part of that is then you start getting into like estate planning. What does your will look like? Things like that. How are you going to pass your assets on to your heirs? Or how are you going to give some of these assets away to charitable organizations? What can we do there? And so it becomes more, at that age, it's when is vocational freedom? What is a sustainable income stream? How do we manage taxes? And how do we distribute these assets to your heirs and charitable organizations?
Gotcha. So you mentioned wills. So how did you know Shawnee Major with Will to Click?
Yeah. So Shawnee was introduced to me through just a friend of ours. We were kind of just talking, and then he's like, you need to meet Shawnee. She's doing some really interesting stuff around wills, mainly around just people have stuff, and it's very hard to get all that stuff into a will. And so Shawnee with Will to Click is come up with a way to kind of catalog all the things that you have to make sure that they get captured in your estate plan, so that there's no question of like who gets what or where things are, things like that.
Yeah.
And so, yeah, we got connected.
Cool. So, crypto's going really crazy, and a lot of people, I don't know. I mean, like a lot of people think, oh, it's like you should just put all your money into crypto now. Why would you like buy all these other assets? It's seeing this insane return. What's your opinion on crypto? Would you invest in it? Do you invest in it?
I have crypto.
Okay.
And the way that I view crypto is it's fun money. It's not part of my long-term financial plan. And so I have very little. It's part of a diversified portfolio. It's not my only investment. And I would venture to say that a lot of people say that crypto is not an investment. There's no cash flow associated with it or things like that. But it's out there. You can buy it. I own some of it. I'm not an evangelist saying like, hey, go buy crypto. Everybody should own it or things like that. That is just a fun choice that I made to have. But I don't tie it into my financial plan.
Gotcha. So it's not going to change all the advice that you've been giving people, and it's not going to change any of that.
At this point, no. It's if someone wants to buy crypto, to me, it's like just gone out and buying an individual stock. Like that's your decision. We have a ton of clients that have side accounts in which they do their thing, and that's totally fine. But what we tell them is like, yeah, go for it. But let's make it to where it's like, if this goes to zero, like you're not impacted. Like this doesn't impact whenever you can reach vocational freedom. And if this thing goes to, a gabillion, it's like, great, you got vocational freedom earlier. Like no harm done kind of a thing. And so we just try to position it to where it's like, if you are going to buy crypto, just as much as if you're going to buy options or you're going to buy an individual stock, let's just make sure that it doesn't impact your long-term plan if it doesn't work out.
Gotcha.
And that's not just crypto only. That's all that type of stuff.
Just like, so how do you feel about Robinhood and the accessibility that people have now? I mean, I think Robinhood's really cool. I don't consider myself a stock picker. My approach was like, the pandemic's going on. Mm-hmm. I'm going to play around on this and buy some stuff that was down, that wouldn't put me in a bad situation if it continues to go down.
Right.
I think it's cool in that way. How do you feel about just the accessibility?
I think if the more people that we can get investing, in the market and comfortable with what the market does, I think the better we are long-term, because it opens people's eyes to the power of compounding, and returns and things like that. What it also has the potential to do, and this isn't just Robinhood specific. I mean, you can buy an individual stock on a variety of places, not just Robinhood, but I think it can create some false confidence that like I can pick stocks, I can do better, because as we've seen since essentially middle of March of last year, like everything's gone up. Granted, some things have gone up more than others, of course, but I think it can create some false confidence. But at the same time, I think it's created a lot of wealth for people. And so now it's just up to them of like, I've got this pile of money that I didn't have. Should I start to think about that more from a long-term perspective as opposed to just a handful of stocks? And so it's like, if we can start to teach people about that aspect of finance and how they can take this essentially like, hey, you won the stock lottery. Like, that's awesome. Like, I'm super stoked for you. Let's take that though, and let's position it to where it's protected and it's going to support you long-term, as opposed to potentially have it exposed to where maybe it goes down and then like you've lost the stock lottery.
You had that. Now let's keep it.
Exactly.
Yeah.
So, but no, I'm all for more people having access to investing, and they've made it available to people. Now, I don't know if I'm necessarily for margin, and like you read about these stories about like a 12-year-old has like a $500,000 line of credit for margin. I don't know if that's true. I'm just making that big number up, but it's like, there are some ways that people can unintentionally hurt themselves, but it's just, it's up to them to read and learn about it. But yeah, I think it's good that people are learning about investing.
Yeah. What'd you think about the whole GameStop madness?
That was wild.
That was real wild. It's like still going on.
Is it? Oh man.
I look sometimes and I'm like, it's still like going up and down like pretty wildly.
Yeah, that is wild. And once again, I was talking with somebody that had an account, and they brought up, GameStop and things like that. And I was like, I hope that if you did buy it, you were able to get it like in a Roth account, so that whenever you go to sell it, like you don't lose all that in taxes. Because if it's in your brokerage account and you sell it at a less than a year is considered a short term, and there's different tax rates. You're going to pay ordinary income tax rates on that. Whereas if you hold it for a year, You pay long-term capital gains, which is either 15 or 20%, depending on your tax bracket, but you're going to pay taxes on that. And so you see these people that have these massive returns and you're super excited for them to like have, once again, hit the stock lottery. And like I'm excited to see people create wealth, however they do it. And so it's like, is there something that we could do to help you save on taxes so you could keep more of that wealth as opposed to pay it all out to the government? And so what are my thoughts on GameStop? It's wild. There are some people that made a ton of money. There's probably some people that lost a lot from whenever they couldn't sell and things like that. That was also just a terrible thing to see, but yeah, it was wild.
Yeah, it's pretty crazy.
Yeah.
So how do you feel about entrepreneurship as a path to wealth? I mean, people do it a lot of different ways. I've had a lot of entrepreneurs in here. Many of them are basically, the story is usually similar. They're usually like, yeah, I was down to $50 in my bank account. I just went all in on something.
Yeah.
I mean, that's the high risk, super high reward. I mean, obviously being a good saver, having a good career. I mean, as long as you do that, you can't really fuck that up. I mean, like you're going to end up pretty rich if you're running the numbers. I mean,
if you're saving, you're doing it for a long period of time, you're going to be okay.
Yeah.
Entrepreneurs, I have so much respect for entrepreneurs. What you just said, it's like, I have $50. And it's like, if I have $50, I'm not starting a business. I'm going out and I'm getting like a steady paying job.
Yeah.
So anybody who has just the gumption to be like, you know what, I've got $50. This is what I'm going to do. And I'm going to start this business because I want to, and I'm really passionate about this and I'm willing to grind. And if it doesn't work, it doesn't work. I mean, that's fantastic. That's such a good story. But unfortunately, there is the other flip of the coin where it doesn't work out. And so
then you got to rebuild everything from scratch.
Yeah. And you're just like, you just hope you're young. But you know, so what am I have an affinity for entrepreneurs because they're the biggest risk takers. And so they should be totally rewarded for that. And they do in their times. And it is a great way to build a ton of wealth. It's also can go the other way.
Yeah.
So, but what do I think of them? I think they're awesome. Yeah.
Cool. Well, do you have any, we're running low on time. Is there anything that you think is interesting that we could touch on or any tips you have?
I mean, like I said, my main tips are save early, save often. So do it in your 401k, build up an emergency fund, start out with low cost, broadly diversified investments such as, mutual funds from, a variety of places like Vanguard or Fidelity or whatever. There's these age-based funds that are pretty much, there's a year that's associated with whenever you might reach vocational freedom. Like those are fantastic places to start out. And then as you get older and you build up some sort of wealth, then it becomes more so matching your portfolio to your cash flow needs. And that's when somebody like myself, like a financial advisor, can come in and can really help with that, as well as just help you understand the tax implications, as well as the estate planning implications. And then, what happens whenever you are an entrepreneur or you are a corporate person and you've got stock options and RSUs and some of this executive compensation. Like people like myself can really help people understand that.
Well, how much money would you say someone should have? When does it make sense to seek out a financial advisor?
I don't know if it's necessarily money or asset wise. I mean, if you've got like no money, probably would be better served to just go take what money you do have and just put it in an asset allocation fund, like I said, at one of these big firms, rather than pay a financial advisor. So at some point, whenever you get up a certain amount of money and it's like this becomes in your mind too big for you to manage, whether it's because you don't have the time or you feel like somebody else could do it better and you just don't have the expertise, that's probably when you want to seek out a financial advisor. But typically, like I said, the people that work with us on Open Plan have anywhere from $100,000 to $500,000. And what they're looking for is just a foundational plan of where do I save money to? How do I think about taxes? What about a will? Things like that. And they're more the do-it-yourselfers. It's like, give me the plan, I'll go execute on my own. And then you have people that want to be hands-off and they're looking for somebody that's like a personal CFO like myself. And typically we start to see those people come to us somewhere around the, $750 million range. But it really spans the gamut. It's just whenever you reach a certain complexity that you no longer want to do this or feel comfortable doing it, seek out advice. And it can come in a variety of ways. It doesn't have to be very expensive.
Gotcha. Well, hey, thanks, Clayton. This was great. I learned a lot.
Yeah, awesome. And once again, I appreciate it. I really enjoyed it, and hopefully be back one time.
Yeah. If people want to find you online, what, LinkedIn?
Yeah. So you can go online. BrightonJones.com is our website. I know you'd asked me this earlier. We've been around for 20 years, work with about 2,000 families, and have under administration about 15 billion in assets. And so we get the opportunity to work with a lot of people and help them. And so hopefully we'll get to do the same for your listeners. But reach out to me on LinkedIn, Clayton Boone with Brighton Jones, or find us at brightonjones.com, and you can just contact us there.
Cool. Thanks.